Earlier we were talking about how the Fed has felt a compulsion to react to some of the global pressures that we see at the moment. So in your mind, what is the biggest risk facing the global economy? Is it trade tension or is it something else?
Well, I think first you have slowdown occurring in China. China is a big part of the global economy, of course. You have what I guess I would call domestic weakness in Europe, with some of the European sovereigns in fiscal trouble. So the general slowdown of the broad global economy, I think, is first. And then it's exacerbated by the trade tensions, which just raises uncertainty as to what kind of a world we're going to be in 6 months or a year or 2 years. And those two things tend to be a somewhat toxic brew at the moment.
So, Dennis, if you were on the FOMC and you were having to weigh in, okay, domestic economy looks pretty good, labor market's maybe not growing fast, but it's growing, but there's these other things, these glowing global risks, and it's not just China slowing down, it's what the trade war's done to Asia, many Asian exporters. And the EU, the ECB just had to open all the monetary floodgates. How do you see the U.S. economy holding up if other key regions are slowing down and continue to slow?
First, the U.S. economy is not as dependent on the global economy or on exports, particularly, as many other countries. So, for starters, the kind of first order of magnitude channels of influence, of global weakness on the U.S. domestic economy in the U.S. may not be quite so direct or quite so strong as other countries experience. Germany, for example, has a big export sector and is highly dependent on both Asia and the rest of Europe for a lot of its overall demand in its economy. So when I was there, I always tried to understand how will this weakness abroad, whether it be European banks, for example, you remember that, or sovereign crises in Italy or in some other European country, Greece, how will that actually translate to weakness in the United States? It is not so clear. That's one of the reasons, as I said earlier in the program, I think there's a divergence of views on the committee as to whether it's time to cut rates or not, because the U.S. economy is simply a little bit more insulated than most from these kinds of influences.
And yet we are expecting more tariffs to get implemented, especially against Chinese goods, right? So when should we start factoring in potential negative inflation affecting consumers here in the U.S., not to mention that we just had the oil prices spike because of geopolitical tensions as well?
Well, there certainly are a lot of risks and a lot of developments out there that are at work at the moment. And you know, one cannot be blasé or sanguine about the overall situation in the world. I'm simply making the point that the U.S. economy is a bit more closed, a bit more oriented to domestic demand. So the key question for the U.S. economy is, when does the U.S. consumer really get, let's say, concerned enough or worried enough to change behavior? And as long as U.S. consumption and retail sales continue to be relatively robust, I think the U.S. economy will enjoy some insulation from the rest of the world. Now, if we have a big shock, an enormous thing happens, all bets are off, clearly. And it was interesting to see that so far, it is interesting to see that so far the oil shock hasn't really materialized, oil price shock, from the attacks on the Saudi facilities. But 10 or 20 years ago, that could have driven oil prices to double. So it's just a different world in terms of vulnerabilities.
Yes, that oil question is an interesting one, isn't it? Because Aramco has moved to replace, I believe, about 40% of that production lost from the weekend strike. But drone swarms, that's something we've been theorizing about for a while in terms of risk, and now it's happened. It seems pretty safe to assume that's not the end of it. That won't be the last one we ever see. So is that a risk that you're closely watching, that this could escalate and that could be the driver of that spike in oil prices that you're talking about?
You have to watch it very closely. If you look back in history, you see a correlation between spikes in oil prices and the onset of recession in the United States. So policymakers can't ignore it entirely. There's a lot of history there. So far, the Saudi authorities seem to have handled it well by giving assurances. The markets haven't, as was mentioned earlier, haven't really seen a big increase in prices. If anything, a little bit of softening in the last few days. So this seems to be being managed at the moment, but we don't know what the retaliation will be. We don't know if it's going to be sanctions or military. We don't know whether there will be retaliation in some material form, but I would expect there to be. So there's so much unknown at the moment, and I think you have to watch it very closely.
Well, you know, one thing that Donald Trump does is he watches the Fed and Jay Powell very closely. But it was interesting to me, maybe it's because there was so much going on, important things, you know, the Fed signaling a mixed vision on what would happen with rates, et cetera, that when Donald Trump said the Fed failed again, no guts, no sense, no vision, a terrible communicator, it really didn't really get into the news flow that much. Do you think maybe finally people are kind of getting numb to this? Markets are getting numb to it? Is it a detriment to the Fed?
Well, certainly it's been going on for a while. And, you know, I prefer to kind of put myself in the shoes of Chairman Powell or a current committee member. If I were there, I and others would be certainly advising that to do exactly what they're doing, and that is ignore the noise coming from the White House. Keep your eye on the ball. Stay focused on the health of the U.S. economy and the achievement of their objectives. I thought today's press conference was just another case of very elegant handling of this unusual pressure that's coming from President Trump. And so far, there's been no blink. And so I am very respectful and admiring of the way the Fed is handling this.
And yet we have heard the opposite view from the former New York Fed President Bill Dudley coming out and saying that the Fed shouldn't encourage President Trump's trade war. What are your thoughts?
I certainly would not have made that statement. I have a great deal of respect for Bill Dudley, and he's a civilian now, so to speak, so he can speak his mind, and I understand the emotions behind it. But realistically, the Fed is not going to take any political calculus into consideration. It's really an apolitical process. Politics don't enter into the decision-making, and they will keep their eye focused on how the economy is evolving and how they're doing against their mandated objectives.